Welcome back to The Close. For more on the markets now, we're going to bring in Brent Joyce, Chief Investment Strategist and Managing Director at BMO Private Wealth. Good to have you join us. Love the jersey. Thanks so much.
Great to be here. Winning day for the TSX. I'm sure we all would have traded it for the gold medal for our women's hockey team. Proud of them still. They put up a good fight.
Yeah, I know. Silver is not what they wanted to see, but still silver is pretty good. Okay, so let's talk a little bit more about the markets instead. We're observing higher commodity prices right now. Like gold prices are up, oil prices are up, driven a lot by geopolitical concerns. I know you've stressed in the past that when you're investing, you shouldn't really be focusing on politics. But at this point, do you believe uncertainty within the geopolitical world is still going to, push prices higher when it comes to commodities?
Gold, not being up more today is actually a bit telling, I would say, given the nervousness that we're seeing in oil prices. The oil obviously is region specific, given Iran. When we think about politics and geopolitics and our investment portfolios, I'm really trying to talk about separating our raw emotions, and very much for Canada in the last 12, 14, 18 months with the trade frictions, and focus on what is it about a particular event that might impact the fundamentals that we really do have to sort of, just keep focused on. And that's earnings, borrowing costs, inflation, wages, commodity prices, things of that nature. So it's not paying attention to it in terms of your portfolio, but it's your emotional response. Try to be very clinical and disciplined. As it relates to today's developments and oil prices, we're up $10 or more from what is pretty low oil prices at the end of December. That's baking in, I think, some of this uncertainty in the Middle East. We're not looking at fundamental supply-demand issues. The world's awash in oil. So it's a question of accessibility. If there was something that would close the Strait of Hormuz, then certainly we would have an issue. It's early days in terms of where this is headed, and the world can still function at $75, $80 oil. Obviously, it was a boost for the TSX on the energy sector today. And so we try to stay calm with that. It's not a non-issue, but keep it in perspective.
Okay. When it comes to companies and earnings season, we've seen a lot reporting a beat on earnings, yet their stocks have still been penalized, it appears, for a lot of companies. Why do you think investors have this kind of cautious outlook on so many companies that are actually reporting a beat on earnings?
Today's a great example with both sides of the board. You had Walmart and Canadian Tire that you guys were talking about a moment ago. It is odd, right? They both posted good results. The Walmart conference call was a bit tepid on their outlook. Those bellwethers would certainly normally signal that the consumer has been in strong, with strength, and obviously earnings are always backward looking. The concern is about going forward, this lower end of the consumer, which both of those retailers, have a contingent of that. How are they going to be stretched? And it does feed back into the oil price conversation. If oil prices are going up, it may not necessarily move the needle a whole pile on the overall inflation picture, but consumer sentiment is very sensitive to oil prices. Inflation expectations are very sensitive to oil prices, outsized to what they really impact on actual inflation numbers. And so that can bring in some nervousness. I think that the weakness for employment is largely behind us. And productivity gains, everybody worrying about, AI going to put me out of a job, I think is far down the road. We generally would see productivity gains, CapEx investment, and then an uptick in employment. And so I think some of the softness is behind us.
Okay, but when we're talking about that softness, some of the weakness on the S&P is in certain sectors like financials, technology, consumer discretionary. Is this a good time to get in and buy on some of those sectors that are a little weaker?
We're still constructive on the U.S. market. I'm very pleased to see that the rotation trade has been playing out really now for 6 months. Those sectors had been big beneficiaries over the last 3 to 6 months. Small caps and mid caps, you could throw into that category as well. So I think we're just taking a healthy pause after what was a pretty good run for some of those sectors. With the rest of the world up 5% in Canada on a year-to-date basis. Europe, Japan, places like South Korea up, very strong out of the gate here. The U.S. is starting to look a little more attractive on a relative basis. There's still high valuations, but it hasn't had the rip. And certainly when you go back 6 or 8 months, it has been treading water sideways. You can correct some of the exuberance in markets through price correction or time. And this has really been more of a time correction for the U.S. market. And so it makes me more constructive towards the rest of the year on the U.S. market.
I'm wondering how you're feeling about the software sector because it's continuing to underperform after taking a hit a couple of weeks ago. Do you expect that weakness to continue?
This is, very fast unfolding story with how artificial intelligence might impact various businesses. I do think on certain companies, there's probably a lot's been overdone. I don't think you can think about large, heavily regulated sectors. The legal profession would be but one, financial services would be another, that are going to use unvarnished, unfettered access to artificial intelligence. Some of these software as a service intermediaries that have been hit hard. I do think there is a case for artificial intelligence being adjacent to their businesses. Maybe that does have some impact on their margins and their earnings going forward. But it does look like there's been quite a shoot first, ask questions later in that space. And that's not unusual for how fast this is moving, and analysts and investors needing to do some research, do some reading, and get caught up on what it actually might mean.
Yeah, it's such quick reaction, right? When it comes to 2026, how are you positioning your fixed income portfolio for the year?
Yeah, fixed income, I think, we've described it as a nothing burger. There's a lot of hand wringing over whether you're going to see one cut, one hike in different central banks, U.S. and Canada. We've seen Australia pull the trigger a bit. I would say in general, the backdrop is easy financial conditions and not expecting major moves. Window dressing of a quarter point here, whether the Fed goes half or a quarter or three quarters of a percent. We can make some money at the margin in that. And so for what we're doing in fixed income is taking up the spread that we're getting in both investment grade and down the credit spectrum for the fixed income exposure. There's not a lot of meat on the bone. The spreads there are tight, but the all-in yields are still attractive. And because we don't expect a lot of fireworks in fixed income, then that's where we want to play that this year.
All right, we will have to leave it there. Brent Joyce, Chief Investment Strategist and Managing Director at BMO Private Wealth. Good to have you join us today. Thanks so much.